If it were to do a 20% retracement on a Thursday, when do I avoid trading Friday? When it does that. I don't care what the market does on a Friday in that instance then. If I have a big weekly range, the candle's been rather elongated and it's larger than the normal weekly ranges have been. And anybody looking at the last 2 weeks, they can say that they're rather large weekly candles. If that's true, and then on Thursday, before Thursday's close, we had at any time a 20% of that weekly range retrace, I will not trade on a Friday because you'll get this type of day here. Whereas we did get the 20% retracement here, because we got that, this is for your notes. When you have that, it tends to create these types of days or sessions. And because it's Friday and it did it in the morning session of Friday, that means after that 20% retracement, then the market can become very fickle. It means that it's back and forth, back and forth, back and forth, and it becomes very problematic to see a very easy sustained price run or a multiple, a large number of opportunities intraday. Whereas a day that's not like this and not one-sided like yesterday, where you can trade both directions. The 1 minute chart gives you a lot of freedom to navigate up and down, and you can get multiple opportunities to measure 10 or 15, 20 point or handle runs and get a lot of experience and practice. Also, by learning what I'm teaching you today, is you'll know when to anticipate these crappy market environments. Whatever we're anticipating TGIF, and TGIF can form at 1 p.m. on Thursdays, New York time. Okay, why 1 p.m.? Because you have to at least give that hour lunch, noon to 1 o'clock, to do whatever it's going to do. And then at 1 p.m. on Thursday, throughout Friday, till Friday's close, I'm always anticipating a 20 to 30% retracement. If we have a elongated, larger than the last few weeks weekly range, if it's up, then I'm expecting 20 to 30% retracement from the highest high that's formed at Thursday, 1 p.m. Eastern Standard Time, going into Friday's trading. If at any time the market has a 20% retracement, as soon as it does that, and if I have not had a trade, I am not going to trade anymore for the rest of that week. I'm done for the week because it's fulfilled its upside objectives and then it's retraced. So think about it as a daily range power 3. It's already done its movement. So now what am I going to be doing? I'm going to be trading in the uncertainty of where is it going to go? Is it going to close higher on the week? Is it going to have a deeper retracement? Is it going to close in an unchanged, no real event taking us out of the consolidation? It's going to just meander around. Think about how a daily candle closes. In the last few minutes, the last 15 or 30 minutes of a day, they're doing what? They're staying in a really small range, off the high, off the low, and they're not trying to make new ground. And they're not trying to trade back to the middle of the daily range either. So that's why you're seeing this type of action here, because it's already done this part here, the 20% retracement. So the weekly range has already, in my opinion, has already done all the work that it needs to do. Its function on the weekly candlestick has done its job. Now, does that mean prices is going to go sideways and never change and just create a straight line to the horizontal line? Of course not. There's going to be fluctuations in price, but the fluctuations in price are going to be rather annoying because they're not going to give you a lot of run. There's not going to be a lot of magnitude and not a distance closing in on something that's obvious that it's reaching for. Does it make sense? Let me give you a graphic depiction. Let's say, for an argument, that this is a candle on the daily. Okay, so this is daily power 3. And let's say, for instance, that the market starts trading right there. Okay, and then it trades higher. And this is where it closes for the day. So what we have here is, this is a hypothetical daily range. Let's, for the sake of argument, say that you believed in advance that it was going to be an up close day or a big bullish day. And then once it goes to a target and then starts to retrace, if we measure the high to the low that day, 20 to 30%, if the market comes off the high that it forms here, after it does that, and you anticipate the market doing what? Coming off the high. It's not always going to close on the high. If it's bullish like this, usually the close is going to be in the upper third of the candlestick. So that means here's your half. So if you do it in 1/3, 2/3, upper third, the close is going to be in the upper third of the candle for the daily range. That's power 3. That's new information, by the way. If you didn't write that down, you missed it. But generally, what you'll find is that when it creates its objective to the upside, it'll retrace 20 to 30% on the day. Not always. But now if we apply this same logic to a daily candlestick, Do we anticipate the market closing on the highs? No. But if it starts closing on the highs, then we're probably going to have a nice retracement or short the following day. But what does it mean for this day once we hit our target and we start trading down into 20 to 30% of the range? It means it's less likely that we're going to come back to that candle's high because it's already retraced, and now it's going to want to try to settle between 20 and 30% of the range in the upper 1/3 percentage of the total daily range. Now, if we take a quantum leap outside of the daily range perspective and apply that same logic to the weekly candlestick, the elements of T.G.I.F are simply this. When the market trades up for the week, once it's proven itself that it wants to come back and start retracing, which is what it does today, here, and trades back down into 20% of the range. That's the equivalent of this. Once it's done this for the week, I'm done. Because what you're essentially trying to say is, because we traded down to 20%, and now we're going to save this candle diagram that's being crudely drawn out here by me, represents the weekly candle, okay? Because we had the high here, and it traded down 20% here, I'm not confident, once it does this, to ever try to trade to get a new higher high. The conditions between the high and the 20% of retracement after a big up week generally creates these very lackluster, choppy, not real exciting type of days. Can it go up and take the high out and trade higher? Yes, but it doesn't do it more times than it does this type of stuff. Not that you can't find setups, not that you're not a good trader, not that you're not a profitable trader. It just means that if you spend time identifying periods in price action where it's just simply not sexy enough to get me involved with it. It isn't clean enough. It isn't obvious. It doesn't give you very clear levels of this is what it wants to do, this is what it probably will not do, and everything's a 50-50. Do you want to trade in those environments where it's 50-50? Or do you want to be when the market still hasn't traded up to this level yet, and the market could potentially trade up and still reach for something, and always focusing on discounted rates going long? And then once it hits that, then you can expect that it might have a 20 to 30% retracement. So therefore, when you do get those levels up here, take the largest portion off, 80-75% of your trade off, because you don't know post 1 p.m. on Thursday when that 20 to 30% retracement can materialize. Now think about it like this. Say, for instance, that we did not get this retracement on the weekly range of 20%. So it means the highest high and the lowest low of this particular trading week, okay? Say we didn't get that 20% retracement yet, and where we're trading time-wise, not price-wise, time-wise, I would expect the market to try to sell off to try to explore that 20%. But because we have had this happen already here, right there, it's more likely that it's going to create a lot of price action that is fuzzy, okay? Like it's real fuzzy, back and forth, back and forth, back and forth. It's going certain places, yes, but it's not running like from here, displacement, inefficiency, displacement, inefficiency, displacement. You see that? Contrast this with all this garbage. When does that come into the marketplace? When is it visible in price? After it's already done 20% retracement on the week. So now it's going to take something for, well, let's say it this way. It's going to be a manual intervention for it to create a higher high on the week. There you go.